It is Tuesday morning. You are standing in your kitchen with your phone in one hand and a stack of unopened mail in the other. The room is quiet, except for the low hum of the refrigerator and the sound of traffic somewhere outside your apartment window. The coffee beside you went cold 20 minutes ago. You did not even notice. Your bank balance says $86.04. Then another notification slides across the screen. Auto pay scheduled. And for a second, your entire body goes still. Not dramatic stillness, not panic in the movie version of panic. Something quieter than that, a tightness in your chest that feels familiar enough to almost be routine. Your brain starts doing calculations before you are fully awake. If the payment clears, the account gets dangerously close to zero. If it bounces, there is a penalty fee. If the fee hits, the credit card balance creeps higher. If utilization climbs again, next month gets tighter before it even starts. And suddenly, the entire week feels fragile. That is what financial stress actually feels like for most people. Not loud, not cinematic, administrative. Small countdowns stacked on top of each other until your whole life starts feeling like a system you are barely holding together with timing. You start delaying things automatically. The dentist appointment can wait another month. The engine light probably is not urgent yet. Maybe the pain in your shoulder is just stress. Maybe the phone battery can survive another few weeks before it completely dies. You begin negotiating with reality itself because your margin for error is too thin to absorb interruptions. At this level, even small problems arrive with consequences attached to them. A parking ticket matters. A sick day matters. A broken appliance matters. Because when your financial buffer disappears, every inconvenience becomes personal. Every surprise becomes structural. Now, imagine someone else waking up at the exact same hour on the exact same morning. Before the market opens, their portfolio drops $52,000. One bad earnings report, one biotech trial collapses, one overnight headline out of another country. On paper, the loss is enormous. But nothing in their actual life changes. The mortgage still clears automatically. The investment accounts continue compounding. The vacation next month still happens. Dinner reservations stay booked. No urgent calculations begin running through their nervous system. Not because they are emotionally tougher than you. Not because they discovered some secret mindset. Because the structure around them absorbs the impact before it reaches their daily life. That is the real difference between levels of wealth. Not intelligence, not motivation, not even discipline by itself. Exposure. At the bottom, the system touches you directly. At the top, it reaches you through layers. Layers of cash reserves, layers of assets, layers of credit access, layers of insulation between a bad event and real personal pain. Most people think this conversation is about rich people versus poor people. It is not. It is about how money changes your relationship with pressure. At the bottom, money feels like survival. In the middle, money starts becoming insulation. And at the top, money becomes leverage over time, opportunity, and risk itself. That is why wealth changes the way people think long before it changes what their life looks like from the outside. Someone who is broke thinks in days, how to survive until Friday. Someone stable thinks in months. Someone with investments starts thinking in cycles. And wealthy families often think in decades, sometimes generations. The higher you move, the less your life gets controlled by urgency. And eventually, the rules change completely. Because above a certain level, wealth stops being only about effort. It starts becoming about access. Who gets invited into the room early? Who hears about opportunities before they become headlines? Who gets enough time to survive volatility while everyone else is forced to react immediately? The truth about wealth is not how much you can spend. It is how much damage you can survive without your entire life collapsing around it. And once you understand that, the entire financial system starts looking different. Because the real ladder was never income. It was always the distance between you and panic. At the lower levels of wealth, effort feels like the whole game. You work longer hours. You stay late. You pick up extra shifts even when you are exhausted because saying no feels irresponsible. You avoid unnecessary spending. You tell yourself you will rest later, after things stabilize. And for a while, that approach works. Discipline matters. Consistency matters. The ability to delay gratification matters. People at the bottom do not survive without those traits. But eventually, something begins to feel off. Not immediately, quietly. You start noticing that two people can work equally hard and still end up in completely different worlds financially. One person spends 10 years building savings slowly, buying index funds every month, hoping compounding eventually creates freedom. Another person gets access to a private investment before the public even knows the company exists. One hears about the opportunity on television after the valuation already exploded. The other heard about it over dinner months earlier through someone already connected to the deal. That realization changes the way you see everything. Because it becomes obvious that above a certain level, effort still matters, but effort stops being the main door. The game shifts into something colder: access. Who introduces you? Who allocates capital toward you? Who trusts you enough to pull you into private conversations? Who lets you sit near opportunity before it becomes narrative? At the bottom, survival depends mostly on labor. Higher up, outcomes increasingly depend on positioning. Not because wealthy people never work, many of them work constantly, but because the structure around them changes. Minimum investment thresholds appear, private placements appear, closed circles appear, and eventually, the biggest opportunities stop becoming visible to the public at all. That is when wealth starts looking less like income and more like proximity. And once you see that clearly, the machinery underneath the system starts revealing itself. Money moves through layers. The first layer is simple. Paychecks flow into bills. Whatever survives moves into savings. Then retirement accounts. Then index funds. For most people, the process ends there. But higher up, the structure becomes more complicated. Capital moves into funds. Then private structures. Trusts. Tax vehicles. Family offices built not just to grow wealth, but to protect it from volatility, taxation, lawsuits, and time itself. And every layer along the way takes something. Banks profit from debt. Funds profit from management fees. Advisors profit from allocation. Institutions profit from controlling liquidity. The system is not only designed to create wealth, it is designed to route money through structures that continuously absorb value from movement itself. Then comes the second layer: power. At the bottom, most people spend their lives reacting to decisions made somewhere else. An employer cuts jobs, a lender raises rates, a bank suddenly tightens credit. An insurance company changes a policy. A landlord increases rent because property taxes went up. And ordinary people adjust in real time because they have no choice. They absorb the decision directly into their body, into their schedule, into their sleep. But higher up, people are often positioned before events fully arrive. Not always because they predict the future better. That is another comforting myth people tell themselves. More often, they simply have earlier access. Better information flow, stronger buffers, relationships inside institutional networks that move slower and more calmly than public panic does. That changes behavior completely. Because when you are protected from immediate consequences, you stop making emergency decisions. And emergency decisions are expensive. Then comes the final layer: consequence. This is the layer almost nobody sees clearly because it hides inside normal economic language. When markets crash, people near the bottom often sell because they need liquidity immediately, not because they want to, because rent still exists, debt still exists, children still need food while the portfolio is collapsing. Meanwhile, people with large reserves quietly buy into the same collapse because they can survive the waiting period afterward. When interest rates rise, one family loses access to home ownership. Another acquires distressed property at a discount. When layoffs happen, thousands of workers suddenly lose income, health insurance, and stability overnight, while investors discuss whether the cuts improved quarterly efficiency. That is the part that feels cold once you finally see it. Risk does not disappear inside the financial system. It moves, usually downward, toward the people with the least protection from timing, volatility, interruption, and delay. The system does not eliminate pressure. It decides where pressure lands.
Subscribe for more story about money, power, and the system.
And after enough years inside different levels of pressure, people begin changing psychologically. Not just financially, emotionally, neurologically. Someone living close to panic starts thinking in shorter time horizons without realizing it. A broke person fears interruption, a missed payment, a broken transmission, an unexpected prescription, a reduced work schedule. Someone stable fears losing momentum, watching the emergency fund shrink. Watching years of discipline slide backward during one bad economic cycle. Wealthy people often fear something else entirely. Losing positioning, falling behind networks they once belonged to, missing access to the next layer of opportunity. And at the highest levels, fear becomes even more abstract. Control, maintaining influence across institutions, protecting structures large enough to survive political change, market cycles, and generational transfer. Preserving legacy across decades instead of months. That is why wealth changes behavior long before it changes lifestyle. The closer someone lives to panic, the more their decisions compress into survival mode. Not because they are irrational, because their environment punishes long-term thinking. Meanwhile, people protected from immediate consequences gain the ability to think strategically, patiently, sometimes even generationally. That difference compounds quietly over time until two people living in the same economy begin experiencing completely different realities. And eventually, wealth itself starts moving differently. At a certain level, money stops flowing through public channels first. That is where most people lose sight of the real structure entirely, because ordinary investors usually encounter opportunities as finished products. A stock already discussed on television, a startup already covered by financial media, a housing market already inflated by institutional buying. They believe they are entering opportunity. In reality, they are often entering the outer layer of something that has already been positioned internally for months, sometimes years. Higher up, the flow looks completely different. Private equity allocations, invitation-only venture rounds, private credit deals, institutional placements with minimum thresholds large enough to automatically exclude almost everyone. And the filtering process is rarely based on intelligence alone. It is based on reputation, networks, introductions, who already trusts you with proximity to capital. This is the room before the room, the layer where conversations happen before narratives become public, where relationships matter more than visibility, where access itself becomes an asset class. Most people think wealthy individuals simply discover better investments, but often they are seeing an entirely different category of opportunity altogether. Not because the system is illegal, because the system is layered. The public sees headlines. Higher layers see deal flow. The public reacts to price movement. Higher layers position around liquidity, taxes, timing, and structure before momentum ever reaches the crowd. And by the time most people hear about the opportunity, the best layer of it has already been distributed. That is the part rarely explained openly. The higher you go, the less wealth looks like money, and the more it looks like access. But once you reach that realization, another truth becomes impossible to ignore. Most people misunderstand what wealth is actually protecting people from. Because the final form of wealth is not luxury, it is reduced exposure. Reduced exposure to emergencies. Reduced exposure to desperation. Reduced exposure to bad timing. Reduced exposure to volatility forcing immediate decisions. People imagine the wealthy obsessing over watches, private jets, and status symbols. Some do. But beneath the surface, the real obsession is stability, continuity, preservation, the ability to survive shocks without collapsing structurally. That is why the financial system is not truly optimized for fairness. It is optimized for liquidity, for organized capital remaining intact, for large structures surviving disruption long enough to reposition themselves afterward. And once you see that clearly, many events begin looking completely different. Market crashes, inflation, layoffs, rate hikes, bank rescues. The language around them sounds public, but the protection inside them is often distributed unevenly. Because the higher you go, the less the system is allowed to touch you. And that reality matters even if you never become ultra wealthy yourself, because this system already shapes your daily life, your debt, your retirement account, the price of housing, the timing of layoffs, the investments you discover too late. The moments when ordinary people buy near the top because institutional positioning happened months earlier. Most people are taught techniques, budgeting, saving, investing. But the deeper danger is misunderstanding the board itself. Believing everyone receives information at the same time. Believing all participants absorb volatility equally. Believing effort alone determines outcomes inside a system built around positioning. Most people are not losing because they are lazy. They are losing because they are playing a game they were never shown clearly. And in the end, the truth about wealth comes back to something very simple. Somewhere tonight, another person is staring at a nearly empty bank account, hoping an autopay clears without triggering a chain reaction through the rest of the month. Somewhere else, another person absorbs a six-figure market loss without changing a single decision in their daily life. Both are living inside the same economy, but not the same level of exposure. At the bottom, money decides what you are allowed to survive. In the middle, it decides how much damage you can absorb. At the top, it decides whether damage reaches you at all. The truth about every level of wealth is not that rich people simply have more money. It is that the higher you go, the less the system is allowed to touch you. Subscribe for more deep stories on money, power, and the system.
Subscribe for more story about money, power, and the system.